Fire Department attention for an investment meeting. Today is 10/15/2014. It is about 7 minutes after 10. We're at New York City Controller's Office, 1 Center Street, room 530, New York, New York. We need a roll call. Trustees?
Mr. Wolford.
Here.
Ms. Suzanne Vickers. Here. Mr. Justin Hall.
Here.
Mr. Steve Cassidy.
James Levin, Steve Cassidy, Currency.
And Mr. James Levin.
Here.
Mr. Addie Brown.
Here.
Mr. John Kelly.
Here.
Mr. James McGowan.
Here.
Mr. John Farina.
Here.
Mr. Paul Furrow.
Here.
Mr. James Briardi.
Eddie Brown has applause.
Commissioner Douglas White.
Here.
We have 24 votes in the quorum, and we start the meeting.
Public agenda?
Okay. Public agenda today is a review of the August results. It was an up month in August, up 2.31% for the total fire portfolio versus the benchmark of 2.09%. Martin Gantz is going to take you through the ups and downs in the market. We are at a period of time where month to month the stock market and the bond markets are chattering around with flow events and so forth. So Martin will take you through the details.
Thank you. Good morning. Morning. So I'm looking at this book. We have extra copies. Do you have it in front of you? Okay. Take you through a few pages. You'll see the pages as far as the economic data continues in the trend that we've been talking about for, quite frankly, the last year or more, which is slow and steady growth, but below trend historically for recovery. For instance, if you take a look at page 4, the weekly unemployment claims are below 300,000 a week. Historically, as you see the trend from 5 years, that's clearly better, but at this point in the recovery, it should be even lower. The unemployment rate itself, this is the headline rate, we talked about this before, that's on the very next page, is now down below 6%. But the real unemployment rate, and the reason why consumer sentiment on the next page is not as high as it should be historically, is because the unemployment rate excludes discouraged workers, excludes part-time workers, the headline rate, excludes certain types of workers, seasonal workers. And the reality is the consumers know that. And there are other measures of unemployment that are not broadly disseminated, but are on the Department of Labor's website that does give all those statistics. And that's why if you look at the consumer sentiment on the next page, on page 6, 84 looks like near the high. That looks awfully nice. But historically, the University of Michigan survey at this time should be well above 100, just to give you some context. So things don't feel as recovery-like in the past. Page 13 is a very important page. That's inflation. Inflation is well under control. The latest print was 1.7, and the estimates are 2% or less going forward, despite the QE and the $4 trillion balance sheet of the Federal Reserve. That's in the short run. In the long run, that's a different story. Scott mentioned that the markets have been very volatile lately. So to start, pages 15 and 16 show exchange rates. So page 15 is just the dollar index versus a number of large global currencies, and page 16 is simply the euro versus the dollar. So on page 15, the up line simply means a strength in the dollar, and you can see it's fairly dramatic. And page 16 shows versus the euro, and at the time of this printing is 125. It's approximately there now. But it was at 130 to 140 for the longest time. And the market is finally recognizing that European growth is slower and interest rates will be lower there for a long time. And in the U.S., quantitative easing is ending, and interest rates, the question is not whether they'll raise, but when they'll raise. And the way economics work, an investor will invest in a higher interest rate environment. All things being equal, if the stock goes up 10% in Euro land or the U.S., if the U.S. dollar is doing well, the investor will do better with the stronger currency. So we've been seeing flows into the U.S. On page 18, the VIX. The markets are moving so fast that this was just printed, as you know, a week ago. timing of this, it looks like a flat line the last few years. The volatility has been extremely low. It's been slow and steady, and in fact, last year was 30% return for the Russell 3000. The time of this printing, it was 14. I know the print this morning, I just checked before I came down here, was in the low 20s. So volatility is certainly spiking, and you're seeing that because day to day, just looking at the headline news, the Dow Jones or even the S&P, we're seeing 1% moves or near that as not being unusual. And historically, for the past several years, that is unusual, and we're now seeing that day after day after day. Mostly on the downside, and then an occasional bounce back on the upside. Page 20 is the 10-year Treasury rate. At the time of the printing, this was 2.4%. As you know, I've said it before, and you may not want to hear me say it again, but the expectation is for rising rates, and rates will rise. The question is when. This morning, rates were actually below, a smidgen below 220. I don't know where they are right now, but they were 219.9 first thing this morning. So investors are selling equities and buying what they consider to be safer securities, putting in cash and treasuries. The next page on 21 is spreads. The numbers that you see here, you can see a slight tick up. On the red, it's almost not noticeable. And on the blue, which is high yield, it is a little bit more noticeable. But they are even higher than that now. What that means is there's a mark-to-market loss in the last month in high yield, what we'll go through in a moment. But also what that means is going forward, the yields are higher, so much more attractive. The earnings are in the next few pages, and as we talked before, in the U.S., smaller cap is more expensive than large cap, and globally, emerging market is less, U.S. is more expensive than EFA and emerging markets. That's pages 23 and 24. And the last economic chart is on page 25, and this just shows you, this is really before the latest sell-off in the last week, because when we printed this, the white line is the U.S., and you can see the numbers in the middle of the page, the total return. So the 12-month period, the 365-day period, U.S. return was 16, nearly 17%, and EFA and emerging markets were just barely under 2%. Because of the sell-off that just occurred, EFA and emerging markets would be negative over the last 12 months, and U.S. would be down further from where it is. So now we're going to get to where we stand. So before we do that, what happened in August? As Scott mentioned, August was a good month, and then we'll get into September. So if you turn to the next page, the numbers are hard to see because the State Street logo obscuring the page number, but it's the pages that look like this, right after the economic charts. 2 pages for August. In the first set of columns, you'll see Russell 3000, very, very strong month in August, 4.2%, which brought the fiscal year to date into positive territory because July was negative month. The fiscal year to date is the third column from the left. In the next set of numbers, top 2 numbers are EFA, developed markets, and emerging markets. EFA was roughly flat, slightly negative, fiscal year to date negative, and emerging market debt was positive, and fiscal year to date positive. The last set of numbers on that page is the Core Plus 5. You'll see Core Plus 5 is 139 for the month, bringing the fiscal year to date positive, and that's because interest rates went down. That's why you see the first number, which is the Treasury government sector, return over 2%. On the next page, you see high yield, which was up over 1.5%, bringing the fiscal year to date positive. Bank loans, is labeled here leveraged loans, was positive, very slightly, bringing the fiscal year to date also very slightly positive. TIPS did well, and convertible bonds, because of the equity correlation, since equities did well, and also bonds did well, convertible bonds did well, returning over 3.5%. REITs, you have a REIT portfolio, that's in the last section, returned 2.82%, bringing the fiscal year to date return to 2%. I neglected to mention hedge funds. Hedge funds is on that first page. This is the, not your portfolio, but the index, and the return was 1%, bringing the fiscal year to date return positive. I want to skip to page 31. So what did that mean for the total value of the fire pension fund and returns? On the left, you'll see the total return for the month was 2.31%. Because of the down July, it brought the fiscal year to date return to a positive number in the middle of 1.32%. You'll see pretty much everything helped except for, in yellow, the EFA returns that were negative. I'm now going to go back to September, so turn back a page, which is September. So August was a very good month. The market value, which we'll go through in a moment, was now a new all-time high, just shy of $11 billion. September was a down month. and undid August. So July down, August up, September down, and we'll talk, and October obviously to date down as well. So Russell 3000, you'll see in the top column, top set of numbers in the top set of columns, was down 2%, bringing fiscal year to date flat. E for the emerging markets were down. Emerging markets was down a lot, 7.41%, but because it had a strong prior month, brought the fiscal year to date number down actually less than EFA, so 3.5% versus 5+% for EFA on the negative side. Hedge funds continue to do well, returning 1.45%. The Core Plus 5 in September was down, but that's not because of anything with credit related. It was in that period, interest rates just happened to tick up. That undid itself, as I mentioned, as I showed you the dramatic chart that showed 2.4% on the 10-year, that's now below or around 2.2%. So this undid itself in October. The money that flows out in October from equities partially went into so-called safe securities and risk-free securities, such as treasuries. But in the month of September, because interest rates went up, the Core Plus 5 index was down 88 basis points. Still, fiscal year to date was positive, although very slightly. Next page shows high yield. High yield was down nearly 2%. Bank loans were down about 0.5%. Fiscal year to date was down about actually exactly 1/3 of 1%. Tips were down for the very same reason. Interest rates went up. That undid itself in October, down 2.5%. And convertible bonds, because as I said, it's a hybrid, and interest rates went up and equities went down. They went down 3.1%. REITs are very tied to interest rates, as well as the fundamentals for real estate, and those were down 5.83%, bringing the fiscal year to date just shy of -3%. The next page I want to show, and we'll have full what the returns are fiscal year to date for September in the next meeting, but I can tell you it will bring the fiscal year to date number to a negative number, a low negative number in low single digits. I'm going to turn page 32 over to Scott.
So page 32 tells us how is the portfolio position relative to the long-term asset allocation plan that we have for the fund. And if each asset class were 0, we would be exactly on the plan, adjusted for the monies that we set aside for private equity commitments, etc. And so as you can see on page 32 here, we've reduced the overweight in U.S. equities, the green on the left. It was up at the upper end of the range, up toward 6% when we reported to you the July results. We've moved it down to about halfway along the range to 3.1%. We're still very underweight long-term bonds, Core Plus 5 in the blue, sort of at our maximum underweight. And a lot of the money that was moved out of U.S. equities ended up all the way on the right in what's deemed cash. It's actually short-term securities. This can be securities up to 4 years in duration. And this is even a little artificially high. It'll get burned down due to a combination of beneficiary payments and the skim over the next few months, but it's still a little overweight. And one of the reasons that it's overweight is that short-term bonds are not as overvalued as long-term bonds are, and as interest rates go up, short-term bonds will be less effective. So that's why we're comfortable having a little overweight to the quote-unquote cash bucket and still remaining underweight core fixed income. In terms of the equities, we're more overweight U.S. than foreign equities. As Martin mentioned, the foreign equities are a little less fully valued, and so I wouldn't be surprised to see those numbers even out a little bit over the next few months, as well as us no longer be pushing the bottom end of the core fixed income. This is all rebalancing. It's all selling things that have gone up a lot, buying things that have gone down, kind of allocating to stay on our long-term plan, and they're all part of the usual and customary rebalancing procedures. Unless there are any questions on that, I'll turn it back to Martin.
Thank you, Scott. The raw numbers without the marketplace are shown on the next page, and all of the specifics, the data, the actuals, the percentages, the actual market values for each asset classes, along with the parking place adjustments are shown and where we are versus those ranges are shown in detail on page 34 with the rules of the parking places on 35. So the market value, where does that compare? As I mentioned to you, it's a new all-time high as of August. That will have changed in September. But on pages 37 and 38, we show that. Page 37 shows the last 12 months. That $10.9 billion is a new all-time high. And we ended the fiscal year on page 38, you'll see the 10.7, which at that time was a new record high. So 10.9 exceeds that. Because as of the end of September, I expect that there'll be a slight negative return. Will probably be around that 10.7 number, because you have to take into account while the market went down, the city's making contributions. So the market value includes the city contributions, which are X out of the returns. We'll have that all for you next month. Next page on page 39 shows a summary of all the major asset classes, actually major asset classes, and the returns. And the following pages, starting on page 40, show each manager individually in the public sector, what those returns are, plus or minus, versus the benchmark versus the different time periods shown, whether it's fiscal year, calendar year 1, 3, 5, and 10, as well as the inception. At the very end, we have private equity and real estate, all of your commitments, as well as the cash flows that are associated with those. Those are my comments for the month of August, unless there are any questions.
Okay, thank you, Martin. That completes our public agenda item, and we're ready to go into executive session when you are.
Make a motion. Is there a second?
Second.
Any objections? Hearing none, the motion carries. We should